Top 5 Takeaways from Seth Klarman's 1991 book, Margin of Safety. Takeaway number 1. Value investor versus speculator. Klarman is, above all else, a value investor. And to understand how to be a successful value investor, you need to know how it's different from speculation. Klarman says that speculators look only at the price of a security and trade based on predictions of market behavior. They buy when securities act well and sell when they don't. On the other hand, value investors look at the underlying business's value. They expect profit in at least one of 3 possible ways. 1. Free cash flow generated by the business, which will eventually be reflected in a higher share price or distributed as dividends. 2. From an increase in the price that investors are willing to pay for the underlying business as reflected in the higher share price. Or 3. By a narrowing of the gap between the share price and the underlying business value. In short, speculators look at price alone, while value investors look at the fundamentals. So why are so many people speculators? Klarman says because it's easier. Speculators run with the crowd. If prices are going up, you're one of a million voices saying, "Yep, I think that price is going to go higher." It feels good and comfortable to be in a crowd. Being a value investor means constantly fighting against the push of the crowd, which can often be running in the opposite direction of you. This requires a good bit of hard work, strict discipline, and a long-term outlook. You can treat stocks as pieces of paper traded based on guessing their next price, or you can treat them as ownership in a business. Takeaway number 2. The avoidance of loss is the surest way to ensure a profit. Want to see how important risk management in investing really is? An investor who earns 16% annual returns over a decade will have more money than an investor who makes 20% a year for 9 years and loses 15% in the 10th year. An investor has a better chance of doing well by achieving consistently good returns with limited downside risk than by achieving massive volatile gains with considerable risk to their principal. That's why eliminating losses should be the first and most important priority of any value investor. Hence the margin of safety. A margin of safety is achieved when securities are purchased below their underlying value to allow for human error, bad luck, or unpredictable volatility. So how can you be sure your investments have a margin of safety? By always buying below the underlying business's value and giving preference to tangible assets over intangibles. That means cryptos and NFTs are off the table, friends. The entire strategy of risk-avoidant value investing could be summarized as buy a bargain and wait. It's simple to understand, but challenging to implement. Thanks a lot, human nature. Takeaway number 3. Know how to value a security. Investors have many different strategies and formulas for evaluating a stock's value, but Klarman only advocates using 3. First is a net present value, or NPV, analysis. This is sometimes also called the discounted cash flow, and represents the difference between the current value of cash inflows and the present value of cash outflows over a period of time. In simple terms, it works by figuring out all the money a business might get and spend in the future, then adjusting those future amounts to today's value, like a money time machine. After discounting the future cash flows to present day and adding the positive and negative cash flows together, you have an NPV. If the NPV is positive, it's generally considered a good investment with low risk. The second method of business valuation analyzes liquidation value, or the expected proceeds if a company were to be dismantled and all of its assets sold off. To find the liquidation value, investors look at a balance sheet to see the value of all assets and then subtract the value of the liabilities. The result is the liquidation value. While most businesses derive value primarily from cash flow, a liquidation value can give investors a good idea of the risk each security carries. The third valuation method Klarman uses is the stock market value. That just means looking at earnings and cash flow to see how a security trades relative to similar stocks in the market. Stock market value is less reliable than the other 2 valuation methods, since the entire market could have the entire industry priced wrong. but it's a good method to use occasionally as a yardstick of value. Value investors can use a combination of these three valuation methods. The main point is that every time they get a value higher than the security's trading price, that is the margin of safety. Without one, you shouldn't buy. Period. End of story. Takeaway number 4. You don't always have to be fully invested. I'm sure you know the idiom, keeping up with the Joneses. It refers to using your neighbor as a benchmark of your success, particularly regarding material wealth. If the Joneses put in a swimming pool, you feel pressured to do the same so that you maintain the same level of economic well-being as those around you. The same principle applies to the stock market. Many investors who aim to beat the market stay 100% invested all the time. Otherwise, they say, any idle funds are just missing in action. The rest of Wall Street is, like the Joneses, pressuring you to keep up. But Klarman says if you want long-term performance that outperforms the market, then there will be times when it's best not to be fully invested. In fact, there were plenty of times he was sitting on as much as 50% cash. Investors who purchase a full position can be forced to watch a subsequent price decline helplessly, while those with cash reserves can average down, lowering their average cost per share if prices decline. On the other hand, you don't want to go too far in the other direction and stockpile cash because you're sure there will be a downturn in the market. Instead, you should invest in ways your money will be returned in the near future, like high dividend players, liquidations, and merger arbitrages. Takeaway number 5. Be wary of setting goals. Many investors set goals for annual returns. In theory, it helps you have a better idea of what your total return will be in 10, 20, or 30 years. But Klarman warns that goals can cause you to focus too much on the potential upside of an investment and ignore red flags about the potential downside. For example, you may find a fairly priced security with a 6% return with nearly no downside risk. But because you've set a goal for an annual return of 10%, you disregard that pick in exchange for a riskier investment with a higher potential return. Remember, an investor with a lower return rate without significant losses will outperform an investor with a mix of high returns and substantial losses. Make your goal to always stick to the margin of safety, and you'll be better off in the long run. So don't fall into the habits of a speculator by ignoring the crowd. Prioritize avoiding losses over making profits. Know the right way to value a security. Don't get caught up in keeping up with Wall Street by always being fully invested. And be careful with setting investment goals. Oh, and get on the library waitlist ASAP if you want to read this entire book. Next, you should check out my book summary of the greatest book on investing ever written, The Intelligent Investor. And make sure to hit that subscribe button on your way there.